James, thank you very much for your time today. Really appreciate you talking to us. Janet Yellen's recent comments seem to suggest that it might have to wait for a bit longer. But is that good news or bad news for the markets? Because the genesis of that idea is that the US market is not as strong as she thought earlier.
Yeah, I think the thing is with the Fed and the markets are cheerleaders for the Fed doing the right thing. So they don't necessarily want easier and easier policy. There comes a point at which they start to think, hang on, what about the longer term implications of this? Is the Fed stoking up inflation, which it'll then have to respond to in quite an abrupt way? And also, is it maybe stoking the potential for financial instability through too easy credit for too long? I think right now the market is still greeting a dovish Fed positively. And that's what we saw this week with Yellen's comments, and that's what we saw on the back of the very weak jobs numbers last week. So I think that's where we are right now.
But should one not be concerned at the weakness of the US numbers? Because ultimately it's not great news for emerging markets, is it? A very weak US economy.
Yeah, I think that's right. So what the emerging markets are looking to the US for is two things. One, it's to keep monetary policy easy, which keeps conditions nice and loose for them, enabling them to grow, enabling capital to flow to emerging markets. But second, they want some growth, they want some demand as well. So the nightmare scenario is that you get some hikes because the Fed has committed to some degree to doing that, yet you don't have the growth alongside that. So that would be the worst case scenario for emerging markets. I wouldn't say that the jobs numbers presage that per se, because I would look at those jobs numbers alongside the activity numbers, which are more positive at present. So the Atlanta Fed has a nice real-time economic indicator. Earlier in the year, that was running very, very low at about 0.5 percentage points on an annualized basis. A lot of people were worried about the message that was giving. In recent weeks, that's accelerated up to about 3% at present. So it's still a mixed picture, actually, in terms of the US economy, and not something to worry about too much as a central risk from our point of view right now.
At the start of the year, many more people were worrying about deflation setting in, getting entrenched, and the world veering towards almost recessionary conditions. Yeah. Would you say that, looking at the stock market action, that fear has receded, and is the market right in calling that?
Yeah, I think there have been three sources of relief so far this year for the markets. The first has been a diminishing of recession risk in the US. The second has been actually a rise in the oil price. So down at $30 a barrel or below $30 a barrel, you introduce lots of risks into the global financial system that are not present when oil is a little bit higher, about $50 a barrel or so. So the rise in the oil price has been very helpful for global risk appetite. Third, China has financial issues that it's working through at present. I wouldn't describe China as in the emergency room, but it's certainly something like an outpatient with a serious problem that it's trying to deal with at present. Over the course of this year, we've seen an improvement in China's conditions. The government is working through the quite sizable challenges that they face.
What's the risk that what Japan is unleashing now could be a race to the bottom with currencies, with the way the yen's going? Do you think it could be a matter of time before China wakes up and says we need to play this game as well? Possibly.
I think this year China has a very big reason not to devalue the currency, and that is it goes by the name of Donald Trump. It doesn't want to open the door to Trump, to give him a nice strategy for getting into the White House through bashing China, which would look very, very coherent in an environment where China is devaluing against the US dollar. So I think in the short term, China has every incentive just to keep the currency stable. But this policy mix that we have right now globally, of all the emphasis on monetary policy, on exchange rate depreciation, faces very definite limits in the medium term. We may already be there even. What we need to see is a shift to fiscal policy. We need governments, as opposed to central banks, to share the burden of stimulating growth. That would be a much healthier situation.
You brought up Donald Trump. Is that a looming risk as well for financial markets?
I do think so. Larry Summers wrote a column recently predicting a recession, a Trump recession. And I don't think that's out of the question. I think that you would introduce a lot of uncertainty. You would introduce the spectre of protectionism within, the leading economy in the world, and that's quite a dangerous mix to be heading into.
That's a lot of risks. How does that position emerging markets now? Because as an asset class per se, it's not delivered quite in line with what investors might have expected over the last 5 years. How difficult is it to go back to them now and tell them this is the place to be?
It is tricky because they disappointed for 5 years. Over the very long run, emerging markets do offer, superior returns, albeit with higher risk associated with that. I think right now the question that one needs to ask in terms of should I be buying emerging markets, should I be overweighting them in my portfolio, is whether the coast is clear in terms of crisis risk in emerging markets. And the two potential catalysts for that are, one, that the Fed tightens too sharply and disrupts emerging markets, as it has done in the past actually. And second, that the Chinese economy disintegrates in a very serious way. Now, our view at Neptune is that over the course of this year, both of these risks have receded somewhat. So they're still there, but they've receded somewhat, and so we've warmed to emerging markets on that basis. And looking at valuations alongside that risk, they're pretty supportive. They're not fantastic. They're not a screaming buy, as it were, but you're paying a reasonable price if you believe that the coast is clear in terms of the crisis risk.
But are your big investors more prone to a tactical kind of positioning these days in emerging markets? Because in the long run, this boom-bust cycles, so much volatility, would they rather play rallies or short down spirals in the market rather than staying the course?
I think they would, and I actually think it's a mistake. I think there's maybe too much tactical investing in the mix today. It kind of makes sense that there's too much of an emphasis on that from an optimal point of view, because people get paid for turnover, people get paid for updating views and for giving advice today as opposed to in 5 years' time. For me, the attraction of emerging markets is a long-term attraction. It's the idea that they can produce returns over the long term that are to some degree uncorrelated with developed market equities. There is correlation between them, but you can actually improve the risk profile of your portfolio by allocating to emerging markets, and that's a long-term reason. The economics of investing in emerging markets is also a long-term based reason. We're living in an age where a number of emerging economies, not all by any stretch of the imagination, but a number seem to have unlocked the potential for growth. I think India is the biggest example of that worldwide today, and that's something that investors, wherever they're based, should be taking a lot of notice of, should be quite excited about, I think.
Is India an overweight in your book, in your emerging market funds that you run?
Yeah, it is.
Significant one?
Yeah, it is significant. We really like India as a market. Obviously over the past 5 years or so, politics has played a big role in terms of the ups and downs of the Indian market. A few years ago, it was a hated market. Now it's very much loved. Right now, for us, India as an investment is playing a diversifying role. So emerging markets tend to work best when their value plays. So when the economies are beaten up and the politics looks pretty bad, but there's a sense in which the country is moving through these problems, you would maybe look to Brazil, maybe Russia as examples of that today. That's often when you make the biggest and fastest gains in emerging markets. And so we're interested in those kinds of plays. But India is a very different story today. India is relatively expensive compared to other emerging markets, but there's quality there and there's growth there. So we still want to be involved over the long term in Indian equities.